All. Today we are discussing a very important topic. New related party transaction disclosure standards. New RPT disclosure standards. Really a game changer. Did you know that related party transactions have been a major area of concern in corporate governance? From financial mismanagement to hidden conflicts of interest, RPTs have raised a serious red flags in the past. But now things are changing. SEBI has introduced new industry standards for RPT disclosures that will transform corporate governance and transparency. These new rules, effective from 1st April 2025, ensures full transparency, strict audit committee reviews, and structured reporting, making it harder for companies to manipulate transactions. We'll discuss on structured RPT disclosures, audit committee oversight, strong shareholder protections, and SEBI's new compliance rules. So, what do these changes mean for business, auditors, and investors? How will they prevent financial fraud and protect shareholders? Stay tuned as we break down the latest SEBI regulations on RPTs and explain why this is a game changer for Indian corporate governance. Introduction to RPT disclosures. So, what are related party transactions? RPTs are financial transactions between a company and its related parties, such as promoters, subsidiaries, or key managerial personnel who may lead to conflicts of interest. So, what are RPT disclosures important? Why these are important? To ensure transparency and to prevent financial mismanagement and to protect shareholder interests. So, the RPT disclosures are important. What were the key challenges in RPT disclosures earlier? The challenges are lack of structured data, selective reporting, and no clear pricing made it difficult for audit committee to assess transactions properly. So these were the challenges. So when did SEBI issue new industry standards for RPT disclosures? On February 14th, 2025, with effective from 1st April 2025. The new disclosures are effective from 1st April 2025, which regulation mandates RPT approvals. Regulation 23234 of SEBI LODR Regulations 2015. Now, industry standards for RPT disclosures. What is the purpose of these new standards? The purpose of new standards is to introduce a structured RPT disclosures, ensure transparency, and strengthen governance mechanism. There is a clear structure is defined in these new standards. Who formulated these industry standards? These new standards formulated by ISF, the Industry Standard Forum, with representative from ASSOCHAM, CII, and FICCI under SEBI's guidance. What are the key objectives of these standards? The objectives are full transparency, uniform reporting, stronger oversight, and empowering shareholders with structured information. How would these standards help audit committee? Audit committee is going to benefit because they provide a structured format for RPT disclosures, making decision and making easier and more accountable. And which entities must comply these standards? All listed entities that engage in related party transactions must comply these standards. Applicability of RPT standards. How are RPTs categorized in the applicability matrix? If you see the matrix, So here into material RPTs, other RPTs, and residual RPTs. Other RPTs with promoter involvement. What approvals are required for material RPTs? For material RPTs, both audit committee and shareholders approvals are required. What thresholds applies to material RPTs as defined regulation 23(1) and 1A of LODR? So what is the threshold for an RPT to require comprehensive disclosures? The transactions with related party where the transactions to be entered into individually or taken together with previous transactions during a financial year exceed lower the following. I'll tell you 3 steps. So the transactions with the related party where the transactions to be entered into individually or taken together with previous transactions during a financial year exceed lower the following. The first one is 2% of turnover as per the last audited consolidated financial statement of the listed entity. And the second one, 2% of net worth. Earlier one, turnover. This is net worth. 2% of net worth as per the last audited consolidated financial statement of the listed entity. Except in case of arithmetic value, net worth is negative. And third one, 5% of average of absolute value of profit or loss after tax as per the last 3 audited consolidated financial statement of the listed entity. Hope you are clear. So lower of the following 1, 2, 3, which I said 2% of turnover, 2% of net worth, 5% of average absolute value of P&L after tax. Do all RPTs require the same level of disclosures? No. They vary between comprehensive, limited, and minimum disclosures. Comprehensive disclosures, limited disclosures, and minimum disclosures. So the question is, do all the RPTs require the same level of disclosures? No. There are 3 levels of disclosures: comprehensive disclosure, limited disclosure, minimum disclosure. Type of disclosures required. See, what are comprehensive disclosures? Comprehensive disclosures are full details including past transactions, financial impact, valuation reports, and related party relationships. Comprehensive disclosures are full details including past transactions, financial impact, and valuation reports, and related party relationships. All has to be disclosed in the comprehensive disclosures. Whereas in limited disclosures excluding certain line items, mainly for non-material RPTs. These are all covered under limited disclosures. And what is the minimum disclosures? Based on RPTs, these disclosures will be varied. The minimum disclosures, both information such as transaction details and related party identification. This comes under the minimum disclosures. So how is the related parties' financial health is assessed? Is there any mechanism? Yes. Through audited financial statements or certifications from the related party. So we can assess the related party's financial health. Do RPT disclosures include royalty payments? Sure. Yes. RPT disclosures include royalty payments and even including industry peer comparison for fairness. What information must be provided to the audit committee? So the details of transaction has to be provided to audit committee, and CEO, CFO certification has to be provided. Valuation reports has to be provided to audit committee, and competitor comparison has to be provided to the audit committee. So what certifications are required from CEO, CFO? What certificate they will give? They'll give certificate that the RPT, the related party transaction, is not prejudicial to the public shareholders and is on fair terms. This is what the certification CEO, CFO has to give. The RPT is not prejudicial to the public shareholders and is on fair terms. So what role does an external valuation reports play? See, external valuation reports ensures that the RPT is priced fairly and benefits the shareholders. So how should the transactions with promoters be scrutinized? See, with the detailed disclosures and justifications for the transactions necessity. So with that, then the transactions with the promoters will be scrutinized. What happens if audited financial statement of related party are unavailable? In this situation, the related party must certify their financial details. Then what details must be provided to shareholders? The same information which we are giving to the audit committee minus commercially sensitive data. Because of some commercial secrets that can be excluded. How are the shareholders protected from unfair RPTs? Yes, because of that, through mandatory disclosures, through approval rights, and independent scrutiny, the shareholders are protected. What justification must be provided for an RPT? So the justification why it is in the best interest of the company and its shareholders. Can sensitive information be redacted for shareholders? Yes, but only if it does not compromise the informed decision making. Wherever commercial secrets are there, that can be reduced. How does peer comparison help in shareholder transparency? It helps to the shareholders by ensuring related party transactions align with industry standards and are not exploitative. Then what happened in case of cash transfer to parent entities? In one of the case, investors were concerned that listed companies were funding promoters' financial needs. So how will the new standards prevent such frauds? By requiring independent valuations and also CEO, CFO certifications, and with the enhanced disclosures, then the new standards prevent such frauds. The impact of new standards, how does these standards benefit audit committee? Because by providing structured decision-making framework, these new standards are giving this structure. So because of this structured decision-making framework and prevent biased approvals, how do they benefit to the management? So by reducing compliance uncertainty, with these new regulations, we can reduce the compliance uncertainty and improving corporate credibility. This is an advantage with the new standards. How these are all benefit to the shareholders? Yes, by ensuring transparency and safeguarding against the promoter influence. This is a benefit to the shareholders with the new standards. How does that benefit to the regulators? Yes, by making compliance monitoring easier. Everything is in structure and reducing financial misreporting. That is an advantage to the regulators. How do they impact valuation reports? They mandate third-party valuation reports for fair pricing in related party transactions. And we talk about the criticism also. Yes, there is a criticism on these standards. What criticism generally do these standards will face? Some may argue that they add complexity and extra compliance burden. For them, the answer is yes, by providing standardized and clear format for disclosures. This is what given in the standards. This is an advantage. And do these standards completely eliminate fraudulent intent? If that is the criticism, no. But they reduce loopholes and improve early fraud detection. And why do some argue that these standards create extra work? See, because they require additional documentation and approvals. But this is because of the long-term benefit. If you see the long-term benefits of transparency, this outweighs the short-term effort. Future RPT disclosures. How will these standards impact corporate governance? They will promote accountability and better financial integrity. This is an advantage. Will companies need additional training for compliance? Of course, yes. To ensure proper understanding and implementation, training may be required. Can these standards be further improved based on industry feedback and revolving regulatory needs? Yes. Will small companies face challenges in implementing these standards? Possibly, but they provide a legal playing field for all entities. What is the ultimate goal of these new RPT standards, which are going to be effective from 1st April 2025, to make corporate governance transparent, fair, and investor friendly? This is an ultimate goal of these new RPT standards. Like this video if you support transparency in corporate governance. Subscribe and hit bell icon so you don't miss our in-depth analysis. Drop a comment below. What do you think about these new regulations? Thank you.